Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax updates to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to have Alex Voloshko back on the podcast. Alex is an international tax partner in PwC's Washington National Tax Services practice, where he specializes in value chain transformation and the tax implications of business operating models. Alex, welcome back to the podcast.
Doug, it's lovely to be here.
So you have been on a whole number, I think this is maybe your fourth podcast, and we were reminiscing that the very first iteration of this podcast was in Jeff Jacoby's office, and one of the first podcasts I think that I put on YouTube, and we've gotten a little bit better here. We're sitting in PwC's Policy on Demand studio. It's great to have you back on. And you were also on during the pandemic, which was sort of the low point for the podcast, where I had to do those virtually. Yep. It's nice to be able to actually sit down.
It's great to be back. Thanks for having me.
So maybe before we dive into the tax material, Alex, you emigrated from Ukraine to the U.S. when you were 20 years old, and something I very much admire. And what does it mean for you to be Ukrainian, and how has your family and friends been impacted by the invasion and what's going on there?
It's a very emotional topic, Doug. As you said, it's been a long time, and my family came back. It was still USSR. We came as like Jewish immigrants to this country, and it's been an amazing journey. And it's been very painful to watch what's been going on, and just a whole lesson about standing up to tyranny. But I do have family and, friends, and try to keep in touch and help the way, I can. But it's been a very challenging, painful thing to watch. And I hope that, sanity will prevail.
So do I. Thank you for sharing. All right, so let's move on to maybe some easier topics for you to discuss. Value chain transformation. This is a term that we use, I think, in tax. And for the audience's benefit, you and I have practiced our entire careers together. Mm-hmm. We started working when we were associates almost 25 years ago, if you can believe that, Alex. So how would you describe, Alex, if you were talking to my mom, who's a retired educator, what you do for a living, and what is value chain transformation?
It's a great question. I have to answer this to my kids as well.
Right, there you go.
I think you and I on one of the prior podcasts talked about, what is value chain? What do these words even mean? And the way I simplistically think of it, it's really the way companies, taxpayers make their money, derive their income, so thinking about the operating footprint across, borders, their value drivers, their location of people, factories, distribution centers, and all that sort of is what I think of as the value chain. And the way companies organize it, or the way they make decisions about their value chain, is very much influenced by a whole variety of things. Tax is one of them. So that's kind of like what I think of we do, is we help companies think through the kind of tax dimension of making these important decisions about how to organize their business, their value chain.
Yeah, and I think that it sometimes gets lost on folk. Tax is generally, or oftentimes, the largest expense for a multinational. And I spend a lot of time thinking about direct taxes, but there's also indirect taxes, tariffs, maybe not be considered technically a tax, but these costs of doing business. And as companies are thinking about reorganizing or going into a new country, reorganizing supply chains, we're going to unpack some of these pieces. Understanding what the after-tax implications are critical for a company to understand what the return on investment may be. And so the way I view you is being able to look at a lens of how an operating model works and thinking about, well, what are all the various tax implications? And again, as somebody who spends a lot of time on direct tax, and particularly now in Pillar 2, and that's just one piece of the puzzle, but understanding value-added taxes and the tariffs and some of the, indirect tax costs are really critical for companies. So, I mentioned that we've been doing this for 25 years, and you've always specialized in this area. I've worked with you on a number of projects over the years. How is the value chain transformation, and from a tax perspective, how has that changed over the last 25 years since we started doing this?
That's a great question. The whole world around us changed. The way companies make money changed. The value drivers evolved. The way they operate and engage with their suppliers and their customers now looks very, very different. So I think there's been a lot of real business change that's still unfolding before our eyes.
Sure.
AI, technology, different ways of working, all that impacts how companies operate. So you kind of have that piece of it. And then, of course, the tax rules and the tax policies have evolved dramatically, right, over the last couple of decades. So it's a very, very different dynamic today. I think the one thing that I notice is that there's a lot more recognition, awareness now of what you just talked about, Doug, where tax is a huge part of the economic equation by which a company decides on a business decision. I think, we kind of been in a world where, people were saying, don't let the tax tail wag the business dog, right? I think increasingly companies, especially well-advised, more sophisticated companies, understand that tax, income tax, and direct tax is just a huge part of the economics of business decision we're trying to make. So there's a lot more, I'd say, collaborative and early engagement between business stakeholders and the tax function in making these decisions.
Yeah, I feel like earlier in our careers, and I mean, this is largely because of the way tax policy has evolved and changed, that there were a number of countries that were very aggressive in their incentives in trying to attract foreign direct investment. And we'll talk a little bit about that too, how Pillar 2 has kind of changed the game in that respect. But that, there were situations where taxpayers would choose a location because of the tax implications, because of a favorable ruling or some sort of incentive structure. And I think that what companies have learned, and I think what advisors have learned, that you first have to understand what the business and the operating model is. You mentioned you can't let the tax tail wag the dog. You can have a great low cost, low tax cost environment, but if your business can't operate there, you don't have the right people, functions there, then a good tax strategy is not going to work through the business.
It's been a really interesting dynamic. So on one hand, again, we just said, tax is an important part of economic decision making, whether you like it or not. However you think of tax and tax policy, tax rules, it's a motivator of certain behavior. That's just a reality, right? So from that perspective, if a jurisdiction offers certain tax regime based on their policy, businesses react to it, right? Whether you like it or not. So there's sort of that sort of thinking. But then there's very much the framework of the rules that we're living in. I think done a really good job at trying to make sure that as these decisions are made, they're made for valid business reasons. There's real business behaviors behind it. And so we still see companies, we still see countries trying to use tax policy as part of their tools in their toolbox to craft their overall economic policy. And we still see companies respond to that. But I definitely see just a big shift in the way that companies are thinking about incentives and trying to see, do they really line up with the way they want to operate their supply chain, their demand chain, their value drivers, right? So I think the world where you could just go and monetize these incentive regimes without any substance, sort of with the mailbox, those days are gone.
Yeah, way past us. Yeah. One of the other things I think that I've seen, and particularly when we started, again, kind of earlier in our careers, is the concept of regional centers of excellence, regional holding companies for large multinationals. I think about a U.S. multinational wanting to set up something in Asia, want to set up something in Europe. And, as globalization has really taken over, companies are looking at these kind of regional type of footprints. I think Pillar 2 puts a little pressure on that, in that it just really requires the parent company to understand what those consequences are, whether it's an IR jurisdiction. But I think that regional way to manage a multinational's business is here to stay. But what are your views on that?
So I see this as a bit of a pendulum that kind of swings back and forth, probably in response to a number of things. And I kind of see now, having been doing this for quite some time, as you noticed, crazy to think about that. Companies move from, either like really decentralized, kind of localized way of mindset and operating to regionalizing or sometimes globalizing, and then pendulum kind of swings. I think the truth is probably somewhere in the middle. I continue to see that it's generally inefficient for a multinational company operating across borders to have like a truly localized, very fragmented operating footprint. Like, with some exceptions, that's generally less than optimal, because you end up replicating things, you're not driving the same like economies of scale. So I do see still value in kind of centralization, either at a regional level, sub-regional level, or sometimes global level. The one thing I kind of see, Doug, interestingly, more and more, I think probably because of the kind of post-COVID, virtual ways of working and all the technology we have, like we're increasingly seeing globalization of functions. So I think we're in a world where we're seeing a hybrid of still sort of regionally focused with some global functions that tend to be located a lot of times where talent is. So it's an interesting world. Like, it's interesting when you think about this and try to overlay the tax rules on top of it, because the tax rules were written back in 60s and 70s and 80s, when it was all about factories, and so interesting, overlay that on top of this sort of virtual, fragmented, sort of dispersed way of operating.
Yeah, and I mean, just to unpack that a little bit, obviously the permanent establishment issues, we were talking about incentives and how that, a couple decades ago really drove the tax result and sometimes the footprint. And it was very important that certain people sat in certain locations and did.
Same with Sub-Part F, like the branch rules, or the services rules, right? They very much focus on counting like butts and seats.
Yeah, who's sitting where and where are they doing this? Right. And now post-COVID, it turns out we can really do this wherever.
Yeah.
And that really has changed the game. And you're right, the tax rules, both Sub-Part F as well as the rules to define whether something's a permanent establishment, have not really kept up with the new world order. All right, so let's kind of transition to that, some of the sort of larger macroeconomic and some of the geopolitical trends that we're seeing. I want to start with the concept of business model reinvention. And this is I think there's a number of different terms that can be used, but what does that mean? And, given that kind of the state of play with how much technology is fundamentally changing all businesses, not just technology businesses and tech or pharma, but talk a little bit about business model reinvention, and what do taxpayers need to be thinking about from a tax perspective when the business folks come in and say, hey, we're thinking about changing some major aspect of their operations.
Yeah. And as you've talked on the prior podcasts and you guests have, sort of business model it's a subset of the value chain. Kind of, to me, value chain is end to end. It's everything, right? When we talk about the business model, we're generally talking about more the front end of the business, with the actual sort of revenue, types of customers, the commercial offerings, channels to market. Like, that's what we're discussing. And we've definitely seen, you use the word transformation, there's definitely been a lot of evolution and change in the way companies either make money, what's the commercial offerings. Like, for example, we see more and more companies becoming services businesses. Everything is a service, right? Product as a service, infrastructure as a service, software as a service. Companies tend to really prefer recurring revenue streams. So they like customer stickiness. They use data to try to really attract customers, analyze their buying behavior. So I think there's been a lot of technology-fueled rethinking about what is the commercial offering, what is the path to market. Do we sell through retail outlets, through dealers, through e-commerce channels, delivering through cloud? So you're kind of seeing a lot of changes in, again, the commercial offering, the way to deliver it, the channel, And all of that then obviously very much impacts like what internal capabilities companies need to have in order to execute on that, like people, process, technology, to deliver a new offering through a new different channel. And you're seeing this across industries, right? Whether it's brick and mortar, manufacturing companies or healthcare companies, or, everybody is starting to sort of operate through different channels. And it's getting harder and harder, almost like we always say, yes, there's still industries and sectors, but it's really a lot of times getting hard to like understand what are you looking at. Is this a service company, a technology company, like even something that used to be plain and simple manufacturing company now a lot of times walks and talks like a technology business.
Yeah. Well, I mean, we can relate, right? Like
Absolutely.
we've got the license version now for our Pillar 2 engine, for example. And so, I mean, we're looking at alternative distribution models, different, ways to kind of monetize technology that we have. And we're traditionally a services business. And your point is other companies are going the opposite way, moving from, historic license or technology into a services model.
And why does it matter? Like, why are we talking about this? Because obviously it just implicates a whole different set of tax rules, right? Like if you start selling through the cloud or delivering different offering or modify your go-to-market channel, there's a lot of tax, again, income tax and indirect tax implications to all of that.
So maybe unpack that a little bit. What are some of those tax implications that taxpayers need to think about as they, if they're moving, from a license model, for example, to a services model?
A lot. So to name some, I'll start maybe with indirect tax because that's an item that typically is above the line. So people just tend to get a lot more emotional about things that happen sort of above the tax line. VAT, customs, sort of GST, those kinds of taxes apply very differently if you're talking about a services stream of revenue versus a product sales revenue. So there's just a lot of implications from compliance, cash flow, as well as whether something is taxable or not. So that's one example. The other example, and more in the income tax world, is the character and source of revenue is very different, right? And that matters because things might be subject to withholding tax, depending on how they're characterized. It matters because things are sourced a certain way for foreign tax credit purposes, right? Like, for example, product sales sourced, particular set of rules, where services sourced very differently. And like one interesting thing we're seeing companies whose sort of tax posture historically very much focused on crediting taxes, foreign tax credits, for example, finding themselves in the situations where their services revenue is grown and different sourcing rules apply. So they thought they have plenty of capacity, for example, to absorb foreign tax credits. And now, because of the different characterization rules, may not be the case. So you have to kind of understand that, quantify it, and decide how that affects the economics. And maybe the third example would be the margin on these new revenue streams or new channels. How is that margin captured? At what rate is it tax affected? And like you said, tax tends to be the largest expense item, right? So if company is thinking about venturing into the new revenue stream, new business, understanding the margins, sort of the revenue and expenses from that particular revenue stream, how is it going to be tax affected? Is it going to be taxed at 30%, 40%? We've certainly in a world where it's not uncommon to see double, triple taxation, right? For a variety of reasons. So those are very meaningful sort of monetary economic answers that we're trying to help companies answer.
Yeah, I liked, Alex, that you started with the above the line.
Absolutely.
And because frankly, as we're as tax people talking to business people, many businesses, the business folks are their KPIs are based above the line, right? They're based pre-tax. And so to the extent that there are tax implications above the line, I think that's a great place to be able to start the conversations with business people. But as you know, I feel very strongly like that earnings per share for public companies is an after-tax concept.
That is very true.
So it is very important for business people, even if their KPIs may be above the line, how do you create what I've referred to as a below-the-line mindset? And really educating business people on what those after-tax costs are and how much they can be impacted by attributes, for example, and the type, how the characterization of the income, where the functions are, where the IP are, all very, very big drivers. You had mentioned another thing about data and how important data is now for companies of all different flavors, right? I mean, this used to be, I feel like, more kind of in the tech sector. People were very focused on data, but now with all types of businesses, data is so important for decision making. So what are some things that taxpayers should be mindful of as data starts to transform their decision-making process or even fundamentally changing their business model? How can data play a role, and what should taxpayers be thinking about from a tax perspective when it comes to data being a key decision maker?
It's an interesting question, Doug. So data has always been important, to the beginning of time. People and organizations make decisions based on data, or at least well-managed companies do. We've definitely seen the importance of data increase so much, in part because of ability to gather that data, so technology, computing power to analyze that data science to really analyze it and help decision makers. So all those things advanced tremendously in the last few years, really. So you're right in saying data is something that we deal with a lot. There's always questions about, what is the value of data? That's one example of what the things that tax people ponder. Is data an intangible? Does it have value? And I think oftentimes the answer is it depends, because some companies able to harvest very unique data from very proprietary sources, and that has a lot of value to them and potentially to other businesses, whereas other times data is a bit of a commodity that you can just buy, and it's all about analytics and what you make with that data. But we definitely ponder these questions a lot because it impacts, again, the economics of the operating models. How do you allocate cost, expenses? How do you treat whether raw data, refined data, or analytical activities, and ultimately decision making using that data? All those things is we're trying to take into account as we are advising companies.
So one of the other big changes that we've seen since the pandemic is related to supply chain. In fact, we talked about this over a virtual podcast that we did, 3 or 4 years ago at this point. Now we're a few years past then. What are you seeing from a supply chain perspective? And I think there's obviously, post-pandemic now, there's a lot of geopolitical trends that we're seeing with protectionism across the planet. So how are you seeing that play itself out in the market from companies looking at changing their supply chains? Is that settled? Is that still very dynamic? And what are some of the tax things that we should be thinking about?
It's still very dynamic. We, on the last podcast when we talked about this, we talked about the long cycle of decision making as regards to supply chain. One thing we're finding at these decisions are typically very complex, very expensive, and it's like turning an aircraft carrier. They take a lot of time to kind of percolate through the system. Having said that, there's a lot of crosswinds blowing, whether it's regulatory, tax policy, geopolitics, tax rules, you name it, that affect companies' decisions on how to organize their supply chain, meaning where they source materials, where they locate factories, do they manufacture themselves, do they outsource, a hybrid, and we're seeing a lot of these shifts. Supply chain, kind of like data and kind of like intangible assets, tend to be one of those things that has a lot of tax impact. Again, both income tax and indirect tax. A lot of tax rules very much still focus on supply chain. For example, we still have our manufacturing exception to support, right? That focuses on, whether you meet that exception or not, right? Or a lot of times the incentives that countries design still trying to attract manufacturing activities, right? And that tends to, again, cause companies to rethink their operating footprint. So supply chains have been very dynamic. We're seeing a lot of activity in this area. Some companies are clearly pivoting, either reshoring or nearshoring production closer to their key markets, including U.S. domestic market. And we're seeing other companies still very much focusing on the supply chain at scale, at the right cost structure, which means, locating it all over the world or very heavily in Asia. So all these dynamics are still very much in play.
So I want to maybe shift a little bit to Pillar 2, and then there's still a couple of things that I want to talk about as far as trends. But you had mentioned particularly with supply chains and the incentive structures, we've talked about it a couple times, that countries will have to try to attract business. And I think very common we see, particularly in Asia, but elsewhere, I mean, Mexico has a McHoney regime, where they are trying to incentivize production and manufacturing in a particular country. Obviously, Pillar 2 has come in with a 15% minimum tax that is really specifically targeting, I think, frankly, all types of incentives, including these types, of manufacturing incentives. We're still at the very beginning stages. Obviously, it's 2024. Pillar 2 is now in effect, and I think it's going to be close to 40 countries this year. How are you seeing Pillar 2 change the calculus as companies are thinking about the tax implications and making decisions, whether it's about supply chain or frankly other structures? Is Pillar 2 really changing the game? Are most companies just willing to say, okay, we're willing to pay a 15% tax, and that's still pretty good compared to other OECD countries?
That's a loaded question. I think this book is still being written. Mm-hmm. So things obviously live in this world a lot more than me, but I think a lot of these developments are still percolating, and we're seeing something happening almost every week that we're keeping a close eye on. The short answer is, I think Pillar 2 will probably reduce the impact of incentives, but it will not eliminate it. So the incentives, first of all, the tax is still an important economic cost in the system, and countries' governments still very much look to their tax policy as a way to incentivize or disincentivize economic behaviors. That's just a reality. For sure. So with that, I see taxpayers still very much paying attention to the tax regimes in the countries where they operate and making decisions sort of on that basis. As we talked about at the beginning of this conversation, I think companies are much more prudent in the way they are making these decisions. They're very hesitant to do something without sort of business rationale or just to go grab some, tax incentives. But I think it's a factor, and it'll probably remain so.
Yeah, agreed. And your point, just to reiterate, is that despite the fact that we have Pillar 2 and these regimes that are intended to prevent sort of incentives, countries are still going to compete for foreign direct investment, and tax policy.
And there's nothing wrong with that. I mean,
absolutely. This is the reality of life, and countries, and tax policy is one of the things that they can offer to be able to try to attract that foreign direct investment. One thing that I have not seen is that companies that are operating in a jurisdiction that has incentives, now that Pillar 2 is the law, depending on what the country is, but if it's subject to an IR, next year in 2025, it's going to be subject to a UTPR. I have not seen taxpayers just kind of packing up their suitcases and leaving. Point being is that, there may be cases like that, but that there are these large operational footprints that have been created over a series of years. And to your point, this takes a long time to set up a manufacturing facility or set up a regional or global headquartered company.
Yeah, I think the reality of it is companies operate across geographic borders. So they need to deal with sort of these questions about investments, activities, locations of people, functional organizational design. And they need to pay attention to taxes. So that reality is with us. These rules are just, again, a way to make sure companies are not taking sort of unfair advantage without any business, reasons behind it. And that's probably been the biggest shift. But honestly, the rules have been kind of moving that way, with BEPS, and a lot of the U.S. rules are very much. So it's not a new development.
Directive.
Exactly. It's not a new development. Right. We've been heading in this direction for now, a decade at least, right? So I think it's just a natural evolution of these rules. And but I think companies continue to operate in a very complex cross-border environment.
Yeah. And being able to be nimble and given how dynamic it is really important, particularly from a tax perspective. All right, so I want to shift a little to U.S. tax policy and how that really has driven some behavioral changes or just changes from an operating model perspective. And the first thing I wanted to ask about is, the Tax Cuts and Jobs Act from 2018. It's, 6 years. It felt like, I remember 2025 felt like forever away, that we were getting before, the foreign derived intangible income, rates would change. And here we are, Alex. We're at the end almost of some of these tax incentives, or some of the reduced rate, or the rate I should say, is going up for FDII, for example. With now a bit of hindsight with the Tax Cuts and Jobs Act, there was a lot of questions about that time, particularly for U.S. multinationals, about onshoring IP. Do you take the foreign, intellectual property rights? Do you bring those back? Do you keep those offshore? With the hindsight that we now have, were there any trends that you've seen for U.S. multinationals as they've made decisions about some of their key intellectual property? And, what, kind of looking in your crystal ball as those rates potentially go up, we'll obviously see what happens with the election, but will that really drive behaviors, if the rate of tax that U.S. MNCs would pay on that IP if they kept that in the U.S.?
I think uncertainty is a terrible thing for businesses. It's like you can have the best sort of well-intentioned incentives built into the regime, but like we're seeing, if those things are temporary, if they sunset, it just affects companies' behavior. So I definitely see taxpayers a bit traumatized by the continuing uncertainty and the big swings in tax policy. And I see them hesitant to make any big moves if they can avoid it. So that's just the reality of it. I think it's just a matter of like sort of this uncertainty and frankly, a bit of mistrust maybe even, from the company's sort of taxpayers' perspective, because they don't really know where the tax policy winds are blowing. So I think that maybe slow down some of the behaviors and move that many people expected or predicted will happen. I do see companies pay close attention to what are the types of intangible property. Like we talked about data and digital and supply chain, we're definitely seeing a lot more variety in what is intangibles, what is IP. Companies definitely pay attention to that. They pay attention to where the decision makers located, how's that IP exploited, so kind of ownership versus exploitation is a very important question to understand. So it's a complicated, and I'm not giving a straightforward answer, but
I think that's a great answer.
It's a complicated calculus, but I don't see any big sort of dramatic runs for the doors one way or the other. I think everybody is trying to adapt and anticipate the best we can. And frankly, there's a lot of hedging going on. Can we make moves in a way that you can pivot?
Yeah, I agree. And I think that, there were a couple of kind of well-publicized cases when those rules came out about companies potentially bringing, U.S. multinationals bringing that IP onshore. But I think largely, companies look out at that window and saw that, hey, FDII rates are going up, because the fact that the TCJA had to go through reconciliation and it was, there were the important provisions that were sunsetting.
Right.
I think many companies were concerned that this could just be temporary and they don't want to get stuck sort of either way. And I could not agree more that certainty is really important for businesses. And, without that certainty, they're going to be hesitant to make long-term decisions. And I think another area, something that you and I have practiced a lot in is, for U.S. multinationals, particularly Subpart F. And we had the Whirlpool case that it's now 2 years ago that I think introduced kind of more uncertainty into our, these highly technical rules that we have spent hundreds of hours over the course of our careers kind of parsing. And then, this decision that came out kind of really upended some of those technical rules as we've looked at them from a regulatory perspective, spent some more time, the tax court spent a lot more time in the statute itself. but that just creates additional uncertainty, and I think is a challenge for taxpayers to make structural decisions about what they want to do when there is this tax uncertainty.
Yeah, the one thing I see taxpayers and tax advisors increasingly being comfortable operating in this very fluid and uncertain environment, right? Like you're kind of seeing, I think, people almost like resigning themselves to the fact that the world is highly complex, volatile, and uncertain. And you can see it through comfort level companies seek, right? Like it's really hard to get to a high comfort level on a lot of different things because the questions become so thorny and so fluid. And so I think we're kind of in a world where there's imperfect information, high volatility, tax policy, very complex business environment. It's really three-dimensional chess, you know?
It is. So maybe this is a good way, I think, to wrap things up, because I think, one of the gifts that you have, Alex, is your ability to be able to communicate these complex tax issues to business people. And one of the things that I'm very passionate about is making sure that tax has a seat at the table. When major operational business model changes, any type of key business decisions are made. But I know one of the things that I suffer from is I get into my little tax speak, and start mentioning Pillar 2 and Subpart F and, things that maybe a business person has no interest in, at least from a technical perspective. What advice do you have for a young practitioner or a taxpayer that's trying to get a seat at the table, and how we can better communicate as tax professionals with the business to help them understand why tax is so important?
I have two reflections on this, Doug. One is, and we alluded to both of them. One is tax was, is, and continues to be a very significant economic cost in the system. By ignoring it, you're missing a huge part of the sort of P&L impact of any business decision you make. So I think more and more companies understand that, and it really just elevates the game for the tax practitioners, right? To like be there as these decisions are being pondered and made to at least help companies management quantify these decisions, right? So that's just economic reality. So that's one point. The second thing is what we've been seeing a lot of is tax function found themselves in the situation where they are very close to things like data and process and locations of people and decision rights, a lot of things that are very specific, very systems and process heavy, that very few other people in the organization care about. So like think about the tax department. It's not just about compliance and controlling tax costs. It's really impacting process and systems decisions, because tax department tends to see a lot of these things that are sort of affecting how companies are set up. So that's just it's both a challenge and the opportunity for the tax department to really play a very meaningful role within the organization. Like when you're thinking about designing your ERP system, or when you're thinking about what your statutory ledgers look like, or when you're trying to make decisions about organizational design and where to locate people and what the job descriptions should be and sort of staffing deployment guidelines across borders, like all those things are the tax department can really help businesses navigate. So that's an interesting opportunity for a tax profession.
I love it. We're going to leave it at that. Alex, thank you very much. Always enjoy chatting with you about these value chain transformation and operating model.
My pleasure.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Alex Voloshko, International Tax Partner at PwC's Washington National Tax Services Practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.